Welcome to Credit Exchange, your weekly podcast where we speak to the biggest newsmakers and news shapers in finance. I'm your host, Lisa Lee. This week, my guest is Ariadna Stefanescu, co-head of Global Credit at Permira. And it's so delightful to talk to you. We're here in London, but you have a global mandate. So let's talk about both the US and European markets. First of all, I'd love to discuss your thoughts about the macro environment, because it's just been a very interesting year we have the Iran war, we got artificial intelligence. There's so much going on. So how do you think about the macro view?
Yeah, if I think about everything that happened in the world over the past, 15 months, starting with tariffs and Liberation Day, and then geopolitical uncertainty in multiple places in the world, and also earlier this year with apocalypse, all the AI headlines, the conflict in the Middle East, and of course, various headlines around private credit. I would say it's been a pretty dramatic and exciting 15 months. Having said that, if we think about actually what it means for the economies around the world, the economic environment, but also about the credit cycle, there are various ways in which we can look at it. If I start with the macro, I think it's, at the moment is universally accepted that people expect a slower growth in GDPs across the world, and also for the rates to stay higher for longer. But in my position as a credit investor, clearly a key area of focus is where are we in the credit cycle.
So where are we, Larry? Again, we're in the seventh inning, if we use a U.S. baseball term, which means sort of late in the game for quite a while now. And now it's 2026. Are we seeing some sort of a credit cycle emerging?
That is absolutely the right way of thinking of it. We're clearly in late cycle, but we're not obviously at the turning point. And again, if we look at not just the last 15 months, but the last 2-3 years, we all know the noise. And putting aside the geopolitical noise, also noise around LMEs in the US, around the refinancing wall. If I look back a few years ago when, inflationary pressure in 23, late 23, early 24, there were real concerns about, a turn in the economic cycle. And of course, specific news around big bankruptcies like First Brands last year. There's been a lot of headlines. We all know the noise. However, what actually happened in the market, if we look at the strength of the market today, in both equity and credit.
And the equity markets, I think, are all-time high. The Dow's breaking 52,000.
Yeah, amazing. Yesterday, all-time high levels for Dow and S&P 500 just a few weeks ago. And that theme also, is very clear in the credit markets. So when we look at the credit markets, both liquid and private, both US and Europe, on the surface, it looks that the market is in a very good shape.
Oh, so I'm intrigued because you're saying on the surface. So there's something brewing underneath that I think you want to share with us. And I'll excited to explore it.
Yeah, for the people that have been in the market for a long time, clearly we're looking for signs of weakness and, trying to see how we position our portfolios and how we continue to deploy capital in the markets. But going back to on the surface, the market is very strong. If you look at the spreads in both liquid and private credit, we are at very tight levels, despite all the economic and geopolitical uncertainty.
So let's talk a little bit. First of all, let's unpack the US and Europe, because when I look at the macro view of the two regions, I see a growing disparity. The US seems still to have robust growth and perhaps more inflation because they're taking advantage of the artificial intelligence and the CapEx spending. Europe, I see with less robust, but maybe a little bit lackluster, maybe even a bit of a recessionary pressures because you have the Iran war and the blockage of the important waterway, Strait of Hormuz, where energy prices have been more impacted. Is that your view? But how do you view the two regions? And then we can go to other ones if you would like.
Yeah, I mean, for sure, a lot of the growth in the US comes from AI-related investments. And if you split some of the big indices like S&P 500 and you eliminate the AI-related stock, the picture of the remaining companies in the index, it's much more similar to what we've seen in Europe. There are pluses and minuses of investing in both geographies. A year ago, after Liberation Day, a lot of investors were a bit more cautious about investing in US. Our job as credit investors is to find the companies that they're best positioned to navigate this uncertain markets on a global basis. And at the end of the day, we are credit investors. Okay. What we care about is robust cash flow generation, profitability of businesses, and their ability to service the debt, whether we're talking about very small companies that are financed through our private credit strategies and all the way to the largest businesses we back through our liquid credit strategies.
So let's explore some of these, what you think might be problematic. We started with the credit cycle, software. So AI has amazing boost to CapEx spending and hopefully productivity. But what it is doing right now is impacting software. If you could talk to us a little bit about your view and your firm's view on software, I'd really appreciate that.
Yeah, absolutely. If we take a step back, and if we look at the evolution of software in the context of the credit markets, over the past decade, it has been one of the fastest growing parts of the market, very much mirroring private equity activity. And if you look, for example, at the US broadly syndicated loan and higher market, currently there is approximately 300 billion of debt outstanding backing software companies. And that's just US public debt.
Yeah.
On top of that, you have private credit, and I'm sure we're going to talk about BDCs as well.
Absolutely.
And there's Europe. So clearly, it's an industry that had grown significantly over the past decade, and more importantly, it has outperformed the market, especially in periods of market volatility and economic uncertainty, like in during the COVID period, and also in 22-23. The interesting thing, especially after 23, when we start seeing the first releases of ChatGPT, the market continued to back and support a lot of software businesses, pretty much ignoring,
They did, right?
pretty much ignoring the pace of releases and innovation, but more importantly, the competency of these models. So for the better part of 2.5 years, the market pretty much ignored AI. And at the beginning of the year, it was the only thing that it could see. And we all know what happened, since late January, all transaction related to software financing were put on hold, the market traded down, and the approach of many credit investors, you are sell now and think later.
Yeah.
So everything was painted with the same brush.
Do you think that's correct? Is that it's dangerous? Let's move away, or are you seeing opportunities and so?
We think there are a lot of opportunities, and we have seen two trends since then. Inside individual software businesses, we have seen a bifurcation between the credits that are not considered to be safe and the credit that the market considered to have significant AI-related risk. A couple of weeks ago, we have seen for the first time the first new financing clearing the markets.
Yeah.
Especially in Europe, but also in the US. So clearly the market is open again to software issuers. But in the same time, many companies that were trading in the secondary market in the high 90s a year ago, now they're trading in the low 80s and even further down.
And that's really tough, right? Especially when because I know you have a CLO business, you have a liquid credit business, and when loans just trade down, that's a lot to make up with other investments.
Yes and no. I think no matter what part of the equation you are, raw or against software, what is clear is, first of all, a lot of the bifurcation is very much driven by sentiment.
Okay.
If we look at the performance of a lot of businesses, we're still waiting to see the real impact of AI in KPIs, in financial performance. And we expect that to be the case for the next 6-12 months. That's point one. Point two, if you look at the amount of capital currently invested in software, and I mentioned earlier 300 billion, at least 80 billion of that has a maturity before the end of 2028.
So is that where the opportunity comes in? Because they're going to trade down lower, and there's a lot of lenders afraid to refinance and go back into it. And so possibly there's distress opportunities, possibly stressed. How do you frame that opportunity for yourself?
Yes, I think that is exactly the opportunity. In no matter what side of the equation you are, the truth is, going forward, software businesses will have to pay a premium versus what they paid in the past in order to get financing done. So for platforms that have a big software expertise, we think that this is an incredible opportunity to help companies to get the financing they need. The other thing I would say is, the market focuses on software, but in our view, AI is sector agnostic.
Yes, right. AI services and law firms and
Absolutely.
and these can be disintermediated possibly if AI gets to the hope and the promises that it has.
Absolutely. And the one thing that we know as a firm that has been investing in technology for more than 40 years is that it is a sector that is very adaptable, that has gone through multiple iteration of change, and they have the capability and the mentality of adapting to change. So we believe there will be many software businesses that will adapt and will become the AI winners. There will be a significant amount of value created through that. But equally, we think that the market is underestimating the impact on other sectors.
So, not to give away all your secret sauce, but at a higher level, how are you still looking at who are the winners and losers of the AI revolution is going to be?
So as a firm, we are very much sector driven, from private equity into private credit into liquid credit. We have very clear investment guidelines and investment frameworks that we put together with our colleagues on the private equity side. When we come to technology and AI, this is something that we've been considering for the past few years. It's not something that we have all of a sudden.
I know it did seem to feel like everyone got religion in February. Oh, yeah, this AI thing is happening.
Yeah, so again, without giving too many specific details, there were many companies that we have considered backing a year and a half, 2 years ago, and we didn't proceed because of AI risks. Just based on our conversation, our sector views from our private equity colleagues that, as I mentioned, have been doing this for more than 40 years. So our answer as a firm is to lean into the knowledge and the expertise that we have built as a firm for more than 40 years and use that to our advantage to continue to partner with interesting companies that we consider to be the winners in this pretty exciting technology revolution.
So given the AI, given the macro view, since we're talking about the credit cycle, what is your view on defaults? Because we've had really, really low default rates for a while now. Although some people say if you counter in some of the distressed exchanges, perhaps it's not as low as the headline number suggests. So what is the distress? I mean, what is the default level in US and Europe, but what's your expectation for it going forward?
Yeah, so if we look again at the past 25 years, and I'm going to focus on the sub-investment grade market because that's what we focus on. The peak of defaults were, as you would expect in 2009 when they almost hit 7%, and very similar levels in 2001 and 2002 around the dot-com bubble. But from 2011 onwards, all the way until today, the average default rate for all global sub-investment grade credit is then under 3%. So be pretty lower. Now, everybody's been talking about, defaults increasing, but if we look at 2005, it was just above 3%. So yes, it's higher than the 14-year average, but it's still pretty low compared to the historical norms. Yes.
And probably maybe low compared to the price you're getting.
Exactly. And our view is that we expect defaults to increase. In full honesty, we expected that last year and 3 years ago.
Why is it not happening? Not that I want companies to become distressed or default, but it is a curiosity that it just, this credit cycle has just been extending and we don't see many defaults? Is it because covenants are so loose, or have corporations become more resilient?
I think it's a combination of things. There are some structural changes versus the market back in 2009, but also there are the market itself has significantly developed, and there are now many more pockets of liquidity. But let's talk about in my view, the two key changes versus 2009 are covenants and private credit.
Oh, that's interesting. Covenants I know about, but I would love to hear about how private credit plays into this default or the lack thereof.
Yeah, I mean, if we think about the growth of private credit market, especially in Europe, it mostly happened post Lehman, post financial crisis. The financing, the credit markets before Lehman, especially here in Europe, was very much dominated by banks. And after the financial crisis, a lot of them tightened their lending standards. Borrowers that had less attractive profiles did not have access to financing, and a lot of defaults happened. Now, part of those defaults were also driven by bank covenants. We don't have that anymore. But into this space, we saw private credit emerging. And as a firm, we were part of that initial wave. That's when we started our private credit franchise, when we saw a lot of the companies that we knew not having access to markets and not receiving the financing they needed. And over the past 14, 15 years, that has been one of the biggest changes in the financing market, the growth of private credit
and the liquidity that it provides.
And the liquidity, indeed. So just to give you a very recent example, at the end, we've been talking about maturity wall for a time, and it keeps getting pushed out. Maturity wall was a significant concern in late 22, early 23, when the broadly syndicated market and the CLO market were
really shuttered for all intents and purposes. They were barely doing anything. The banks said that they were open for business, but their terms were so onerous. Every private equity guy said, I can't take that deal.
Yes, and we had many companies that had large capital structures that we were wondering how they were going to receive financing, and in that particular opportunity stepped in private credit.
I remember that one of the biggest deals, Sinastra, yes, were a lot of the people in the credit market saying, this is a game changer because there is another asset class, another pool of capital ready to refinance things that I don't want to refinance, but I'm happy to be taken out.
Yes, Finastra was a great opportunity and a great example because that was a large cap buyout that the market did not have the viscosity to re-underwrite. So when I talk about the default cycle, the lack of maintenance covenants, the new forms of capital, all help. And also, just focusing on the broadly syndicated liquid credit market, there's been a lot of capital raised for that as well, right? There's so much money everywhere.
But the CLO market, for instance, where they're one of the biggest buyers of leveraged loans, their issuance has been booming.
Yeah, 24 and 25, they were both record years of issuance in both Europe and the US. Year to date, 26, we're tracking the levels of 25. And more importantly, we've seen more and more managers, new shops coming to market, new shops coming to market. If I think about the period just before COVID, so in 2019, in Europe, we tracked something like 48, 49 managers issuing new CLOs. Last year, that number was in excess of 60.
Oh, wow.
And we expect this year to be in excess of 75. So clearly more people joining the market in a pretty limited period of time
means a lot of demand. But let's go back to private credit, and then I want to hit more about what's going to go, because it seems to me that there's perhaps too many players. First of all, the private credit, to your point, they have changed the nature of the broader, not just private credit, but also leverage notes and high yield bonds, and also just, the ability to do LBO financing. And some people are going into this middle market, smaller size companies. But there have been some really negative headlines, lots of outflows from non-traded BDCs. Because I know this is more of a U.S. phenomena, but are they still going to be able to help out with the restructurings to your point, given that they're a little bit under siege? I hear that people are writing smaller checks now.
Again, we haven't seen the headlines, but if we start digging a bit more into those, a lot of BDCs have been in the headline at the beginning of the year, especially those that have high exposure to software. That is very much a US phenomenon.
Yeah.
And I mean, even yesterday or last week, there were more headlines of
deal with funds being capped. Investors not getting all the cash that they asked for.
But if you look at how big is this part of the market, we estimate that semi-liquid funds represent only between 5 to 10% of the whole private credit market. The vast majority of capital is in long-term locked formats, with capital coming mostly from institutional investors. But they read the headlines too. Is it still going to be okay? For sure. And the way we look at it is after 10 plus years of fantastic growth, the private credit market is now facing its own maturity test. And what we believe is that the asset class has proved itself. The sophisticated investors truly believe in the asset class. However, they're not going to back every manager.
Okay. Oh, so you're thinking more dispersion. I've heard that part of it. Absolutely. Bigger history starting to matter more.
Yes. I think what matters is relationships, the sourcing capability, track record, and given that we all talk about the late cycle, restructuring capabilities. I think track record and longevity of track record.
And we've been doing this credit for 20 years, and I was raised to 20 years.
Yeah, from the same firm. At the same firm, yes. Permira Credit was set up at the beginning of 2007, and we've been active in both private and liquid credit markets through most of our existence. So yeah, we believe that actually, again, like while the headlines are negative, there is a great opportunity for people that have built a long-term track record to go and prove to their investors that this asset class has a reason to exist.
And so you think private credit is here to stay, is going to stay, but it's a test, right? And when you think that test might be over, and so far, how would you grade it? If you were going to grade how private credit as an asset class is flying through.
That's a very difficult question. How long would it take? I think investors want to see more performance, and especially if we have more deteriorating economic outlook.
Yeah.
Also, in the older funds, they want to see the proof of restructuring capabilities.
Because yes, situations, and also workout groups. I has always said that when you do originating, it all looks very same, but people's ability to work out and to your point, restructure a debt varies widely. Not everyone has, I think, the deep bench of workout professionals, because it's been so long since we've had a default cycle.
Indeed. So inside our private credit team, we have restructuring experts that spend their entire time working alongside our originating and new teams to work on situation where maybe the performance did not go according to the plan. But this situation take a while to unfold.
Okay.
And the more the asset class and the more managers prove to their investors that they have these capabilities and deliver, I think it will reassure a lot of people. And I think that doesn't just apply to private credit; it applies to all forms of credit. So while private credit is currently in the headlines, I think it's also an opportunity to differentiate, and we're going to see more and more dispersion. And ultimately, some people will be priced out of the market.
They will not be able to. So you're predicting some people will be out of this asset class, which that it should be, right? There just should be. Not everyone should succeed. There should be some successes, and perhaps some people would decide that this isn't something they're capable of doing.
Exactly. And I believe that will happen also on the liquid credit side.
And again,
going back all the way to 2009, we have seen consolidation after the financial crisis. Subscale managers that didn't necessarily have the performance or the relationship with their LPs to continue And once again, it's a great opportunity for people that have been in the market for a long time.
So do you predict more M&As happening in the CLO world? Because one thing I've noticed is they can survive for a long time not doing any deals. Years since they've issued a new CLO or done a new deal and just stick around. So at what point do you think some of these might go away? And then we also have all these new managers to point setting up shop. It seems to be one of the most popular new business avenues in credit.
Yes, I mean, if you take the total number of managers that have issued CLOs in the past, Europe and are rumored to come to the European market, the number gets into the high 90s to 100. In US, if you do the same math as 180 to 200, I don't think the market can, support all this number of managers. It's just the market is not big enough for that. And you're right, CLO contracts are outstanding for a long time. As long as you perform, you receive the management fees. But then ultimately, the business case for if you can't grow the platform, at some point, there is a rationale for potentially exiting the asset class or looking to consolidate.
And then, but what's your worry? Because, you're a co-head of credit. And so the one thing I can always rely on with a credit person is they got some worries.
Of course, we always need to see the glass half empty. And every single time we go through this period of uncertainty and dislocation, we take very hard look at the risk that we have and make sure we fully understand the implications, and not just the direct implication of that particular event, but also what could potentially be the impact on the market. So just thinking back at Liberation Day, if you have the way tariffs could impact the business, but also we look at the strength of capital structure, liquidity, and also maturity wall. If there's something that we're worried about, is especially large companies not having access to markets for a reason or another.
Oh, and one of the things I think you guys tend to do is invest in larger companies versus smaller companies when you invest in their debt. Why is that?
I think it depends from strategy to strategy. In our direct lending strategies, we focus on pure mid-market companies. In our strategic opportunities, we focus on complex businesses, and there the EBITDA level is even lower. In liquid credit, there you're right. We focus on the largest, most liquid names that we can find. And the reason behind that is liquidity. We are a very active manager. And when we do our analysis and our credit work, we want to have the ability to trade portfolios and exit positions. And if you are invested in a lot of smaller businesses, say like in Europe, there's not a lot of liquidity.
So if you're going to invest in a smaller company, might as well just go to private credit and get the illiquidity premium. If you're going to invest in liquid credit, then just go with the big names where there's a lot of liquidity. Is that?
Absolutely. And not just the liquidity premium, but when you're in a small transaction with just sole lender or a handful of lenders, you also have a different impact on the business, on the potential, on the performance. It becomes much more a relationship with a sponsor, with a company, and finding a solution together.
So you've been with your firm for 20 years.
The entire time of the almost. And no, I actually joined from JP Morgan.
All right.
I did something before.
Okay. But 20 years is a long time. So what are you excited about at the moment? Because I think the market's changing. Your role changes. What is exciting for you personally?
Yeah, so over the past almost 20 years, clearly was really exciting to be part of a firm that grew from day one.
Yeah.
I joined in Permira Credit when Permira decided to move in the credit, and joining a fantastic brand, but being part of that original team, it's really allowed me to learn a lot, to help build the team and to surround myself with all the people that are now part of Permira Credit. That's been a fantastic journey and a privilege. What am I excited about? We have 2 new strategies that we launched over the past couple of years. In Europe, we launched our Strategic Opportunity Funds, PSO1. In the US, we expanded the CLO platform 2 years ago. So since then, we have priced 5 CLOs already. I'm really excited about how that initiative is going. But looking forward, as continue to deploy capital for our investors across all these strategies, really using the know-how that we have together as a firm gathered over almost 20 years of credit investing and more than 40 years of private equity investing to navigate these uncertain markets. I truly believe we're going to see a lot of dispersion. There are a lot of credit managers that do not have that expertise or longevity. And while I think the next few years might be rocky, it's also an opportunity to really show our investors that we can perform for them and that we deserve the trust that they place in us.
Since you've been at Permira for nearly 20 years, how would you characterize this moment in terms of difficulty of investing and uncertainty? Do you think this is unique, or do you find that this is perhaps all investment cycles are difficult?
I think every cycle is different. Every single maturity wall is different. There are clearly some headlines and some noise in the market that makes you think of the 2006, 2007 period. Having said that, the credit markets have developed significantly since then. We have spoken about private credit, the fact that the market is not so much concentrated on just one pot of liquidity. So I do believe that the next cycle will be different. But for sure, there are signs for people that have been in the market for a long time that make us cautious. But that's where the expertise of long-term track record comes from.
Great. Thank you so much. It's been so delightful to have you here. It's a pleasure. Thank you. And to our audience, thank you for joining us. We're now on YouTube, so do watch us there or follow us on Apple or Spotify or wherever you get your podcasts. This has been Lisa Lee.